Hello there. If you're a trustee for a family trust, then I need you to listen very closely. There's a hidden reporting trap that could cost you thousands. And the crazy thing is, it can happen even when you don't owe a penny in tax. So in this guide, put together by the experts at My Tax Accountant, we're going to walk you through absolutely everything you need to know about Form IHT100C so you can keep yourself and your trust safe.
Let's just start with this number, shall we? £3,200. Wow. That is the potential penalty from HMRC for failing to file a single form on time. And here's the real sting in the tail. You could be hit with this fine even if your trust doesn't owe any tax whatsoever. It's an unbelievably costly mistake for what is essentially a simple admin oversight.
You see, this is a trap that catches so many good, well-meaning people out. Trustees just like you, who are simply trying to do the right thing for their family, but are completely in the dark about this critical reporting duty. It's so easy to assume that if there's no tax to pay, well, there's nothing to tell HMRC about, right? Unfortunately, as we've just seen, that assumption can be a very, very expensive one.
Okay, so to make sure you don't fall into that trap, here's what we're going to cover. First, we'll unpack that reporting trap in a bit more detail. Then, we'll get clear on what a trust exit actually is. We'll look at exactly when you must file the IHT100C form. We'll even walk through the key parts of the form itself, and then we'll finish up with some really clear steps on getting it right.
Right, let's get into it. How on earth can you face a penalty when there's no tax to pay? Let's break down this reporting trap, because honestly, understanding this one simple thing is the key to avoiding a whole world of trouble.
This really gets to the heart of the matter. You need to think of your duty to pay tax and your duty to report to HMRC as two totally separate jobs. So many trustees focus on that left-hand column. They think, phew, no tax due, job done. But HMRC is just as interested, if not more so sometimes, in that right-hand column. They want to know when assets are moving around, even if it doesn't create a tax bill. It's this disconnect, this misunderstanding, that leads directly to that hefty £3,200 penalty.
So if you have this duty to report, when does it actually kick in? What's the trigger? Well, to answer that, we need to understand what HMRC calls a trust exit, or, in their jargon, a chargeable event.
Now, before we get to the exit, we need to be clear on the type of trust we're talking about. These rules are for something called a relevant property trust. Look, don't let the technical term put you off. In plain English, this just means most modern discretionary family trusts. You know, the kind where the trustees, maybe people like you, have the flexibility to decide who benefits and when.
So, what is a trust exit? It's really simple. It's any time capital leaves the trust. Let's make this real. Imagine David and Susan are trustees. Their nephew, Tom, is starting a brilliant little cafe up in Manchester, and he needs 25 grand for some new equipment. David and Susan think it's a great idea, so they give him the money from the trust. That payment, that's it. That's the exit. And that is the trigger that starts the reporting clock ticking. Now you'll really want to listen to this next part, because this is where the specific rules come in. We know what an exit is, but you don't have to report every single one. There are very specific rules that trigger the need to file, and this is what we have to get right.
Okay, let's break this down nice and simple. 4 steps. First is your trust and accepted settlement. Some very simple UK trusts are, so it's worth checking. Second, if it's not exempt, you have to look at the trust's value at its last 10-year anniversary. Now, step 3. This is the magic number you need to remember. As of early 2026, the inheritance tax threshold, or Nil Rate Band, is £325,000. 80% of that is $260,000. If your trust was worth more than that $260,000 figure at its last anniversary, then you must report every single capital exit, no exceptions. And finally, step 4, and this is a golden rule. If you are ever in doubt, the safest thing to do is just file the form.
Right, once you know you need to report, a clock starts ticking, and this deadline is absolutely strict. You have 6 months. But, and this is important, it's not 6 months from the day of the event itself, it's 6 months from the end of the month in which the event happened. So, back to our example, David and Susan gave Tom the money on the 10th of March. The clock doesn't start until the 31st of March. That gives them until the end of September to get that form filed. It's a deadline you just cannot afford to miss.
And here's why. This is straight from HMRC's own rulebook. Look how quickly these penalties escalate. It starts at £100 if you're up to 6 months late. Then it's another 100 on top of that. But look what happens if you go over a year late.
that penalty can shoot up by another £3,000, bringing the potential total to that whopping £3,200 figure we started with. This just shows you how seriously HMRC takes this stuff.
Okay, so we've covered the why and the when. Let's talk about the how. We're going to take a quick look at the form itself, the IHT100C. Now, we're not going through it line by line. It's an 18-page beast, but we will zoom in on the most important bits that you absolutely need to be aware of.
So, the form starts off pretty straightforward. Sections A, B, and C are just about the basics. You know, who set up the trust in the first place? That's the settlor. Who's in charge of it now? That's you, the trustees. And the trust's own details, like its start date and reference numbers. Simple stuff, but it's really important to get it right so HMRC knows exactly which trust they're dealing with.
Now, in Section E, you've got to list exactly what has left the trust. And the key phrase to remember here is open market value. That means you have to figure out what that asset, whether it's cash, property, or shares, was worth on the exact day it was transferred. Precision is absolutely vital. You've also got to be careful not to list an asset twice. And my tip here is to keep every single document you use for your valuation safe. You can bet HMRC might want to have a look later on.
And now we get to the really tricky bit, the engine room of the form, you might say, the tax calculation in sections H and J. This is, without a doubt, the most complex part. The calculations involve things like working out complete quarters, applying all sorts of fractions, and a really complicated concept called grossing up. Grossing up is when the trust agrees to pay the tax for the beneficiary, so you literally have to calculate the tax on the tax. It's a headache. And honestly, this is the point where getting professional advice isn't just a good idea, it's pretty much essential.
And here is a perfect example of why. This is a direct tip from the experts at My Tax Accountant. It turns out the official HMRC form has a known problem, a glitch if you like, where it can get the calculation wrong for a specific type of tax relief. It's a small technical point, but one that could cost you real money. So their advice, every single time, is to submit your own separate calculation with the form to make sure you're paying the correct amount. It just goes to show how valuable that expert oversight really is.
So we have covered a lot of ground. We've talked about the trap, the trigger, the rules, and the form itself. Let's pull all of this together now and look at the practical steps you can take to get this right and get some proper peace of mind.
Okay, let's do a quick recap of the most important things to remember. First, and this is the big one, the duty to report is totally separate from the duty to pay tax. Forgetting that is the #1 trap. Second, the key trigger to report is when the trust's value is over that magic number, £260,000 at its last 10-year anniversary. Third, that deadline is non-negotiable, 6 months from the end of the month of the event. Fourth, HMRC's penalties are designed to sting, going all the way up to £3,200. And finally, remember that the form itself is so complex that even the official version can get it wrong, which makes an expert review pretty much essential.
And all of this brings us to one final, really important question. It's something I want every single trustee watching this to think about honestly. After everything we've talked about, can you say with 100% certainty that your trust reporting is fully up to date? Has any money gone out that might have needed a form you just didn't know about?
If there is even the slightest bit of doubt in your mind, the absolute best thing you can do is get some professional guidance. Navigating these rules isn't easy, but it's exactly what the team at My Tax Accountant specializes in.
You can give them a call on 0208 570 8531, or you can drop them an email at info@mytaxaccountant.co.uk. And for more helpful guides just like this one, make sure you find and subscribe to the My Tax Accountant channel on YouTube. Now, just before we wrap up, a quick and important disclaimer. The information we've shared today is intended for general guidance only, and it's all accurate as of February 2026. It really shouldn't be relied upon as the sole basis for any financial decisions. Tax law is incredibly complex, and of course, your own situation will be unique. So please always speak with a qualified professional, like the brilliant experts at My Tax Accountant, before you take any action. Thanks so much for watching.